Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. What's up, everybody? Thanks for coming back and tuning in. If you like the show, please give it a rating on your podcast player. It means a lot to me. I'm trying to continue to get really great guests on. And if you like this episode, share it with a friend. But why I think today's guest, Adam Webb, is so important, and I've known Adam for 8 years now. He's the managing partner of Quazar Capital. He took over after the partner passed away a couple of years ago. He's done about 60 deals. Is that I've got a history with Adam, and so the relationship is there, and it was just us shooting the shit about valuations, what's going on in the market, what he's seeing with owners as far as their level of being prepared, not prepared, how that impacts valuations. And I just want to make this information accessible to the owner-operators who don't have time to digest the technical intricacies of what Adam and I are talking about till they're blue in the face because you're busy running your company, or once you get out of the business, you don't want to talk about this stuff anymore. So my hope is that through listening to Adam and I, we're making these topics accessible to you. If you want to know more about Adam, check out the show notes below. Otherwise, I really hope you enjoy this episode with Adam. What's up, dude?
What's going on, Brian?
Yeah, there's that some big fancy, curtain that, is unveiling or anything. So I'm very pumped to have this conversation. Maybe what I'll do, Adam, is for the listeners and for you is put it like a container because around the conversation, well, not necessarily around the conversation, but because I want to go to a lot of different ways with this. But there's a couple things on my mind that I'm super curious to pull the threads with. And I'll give us some of the frameworks of discussions based on like the stuff. I mean, you've been on a couple panels of my workshops recently, which has been a lot of fun. And like, when I think about what you're doing, it's super freaking needed because you're a middle market investment banker that's helping the middle market that really can't get any help. And it's the same clients that I'm working with. I mean, everybody's like, hey, if you're above $2-3 million in normalized EBITDA, every investment banker will take you on. And then you got anybody that's like truly kicking out cash. I've got a whole podcast about investment bankers versus business brokers that I can put a link to, so we don't have to cover that whole ground, Adam. And like the fee structures, I really highly recommend people go and listen to that. But like, you're doing the investment banking process for the middle market, so like it's so needed that it's ridiculous. And anyways, I just think we could start there because as outside of a couple of the topics that I want to unpack. What we're going to be talking about, I think is important for the listeners, is if someone has figured out their cash flow valuation, which is the income valuation, then there's the strategic market valuation when you finally decide to want to sell to a third party, not the ESOP, not an internal buyer. That's all. I mean, maybe you can talk, Adam. You might facilitate some of that stuff, but you're taking someone that has hopefully deliberately decided that they want to go to market, and we can talk about how many people actually do that, but maybe that it helps you kind of give a framework so you don't have to go back to the drawing board and kind of give everybody
that's super helpful. First of all, thanks for having me on, Ryan. I've been listening to your podcast. I actually fall asleep with you in my ear a lot of nights.
Well, that's weird.
I thought you'd like to hear that. But yeah, there's a kind of a few go-to podcasts I listen to and I fall asleep in yours. It's
awesome, man.
One of them. Anyway, let me kind of piggyback on what you just said about the market we serve. So my firm's called Quazar. We've been around for 35 years, always kind of serving the middle market or lower middle market of the M&A space. So some of our deals, we are competing with middle market investment banks, the kind of deals that like a lot of investment banks want.
You can get them, right? I mean, like, and that's
correct.
Like, you can do that, but it's just
correct.
Maybe while you're doing this too, talk about like if you're comfortable talking about how many deals you do a year and what your team size is, because like why? Because there's such a constraint on you and your team. That's the biggest constraint. And so like
that's exactly
is that helpful?
I'll say this, like, if people listening to this take away maybe one thing, this is one thing I want people to understand. Like, you can do everything right. Like, they can work with you, Ryan. They can get their business like incredibly sale ready. But if you hire the wrong intermediary, so the wrong investment bank, the wrong business broker, you will get a suboptimal outcome. You just will. Our market, it's kind of like the wild, wild west. It is a free for all. different buyers have vastly different ideas on valuation and structure and what they plan to do with the business post transaction. It is, and I don't think business owners kind of fully grasp how different valuations can be in our market.
Oh, dude, and valuations, deals, structures,
Yeah,
terms and conditions, like what you're going to do with your role. I mean,
like when you go to sell your house, you're probably going to hire a real estate agent. Who you hire does matter, right? But like it's pretty
maybe
it's pretty defined what you're going to get for your house. Like maybe plus or minus 5% depending on who you hire, right? In my world, and I know this firsthand because I've worked on a lot of deals and I see where the offers come in. It like we can have 100% delta between low and high on the offers, and like if who you hire does not kind of run the right process, put together the right marketing materials, contact the right buyers, tell the right story, set the right deadlines, like you will miss out on value. And I don't just say that to be self-serving. I think my team does a great job.
This is why I think it's important, Adam, because like you couldn't take on everybody that called you right now. So it doesn't matter, right? Like, and I think like that's the important thing for people to know. Like, I'm having you on the show because you're doing the right shit with the right process for the right people. And you're saying that because I find the good advisors and whatever designation that they have a hard time sticking out from all the other knuckleheads doing shit that they shouldn't be doing. And then and so you're sitting there talking about, here's the gold standard of what you should expect for the fee that you have. And I'm saying that for you because I get sick and tired of being like, well, there's no difference between Adam and Sunbelt business brokers. It's like, that's not the case. That's not the case. There's a right time and place, I think, for everything, but like, it depends on the expectations alignment.
Yeah, I completely agree. And you're right. I mean, we're we have 6 people here full time. We have 3 part-timers, so we're a team of 9. In any given year, we'll do between usually 5 and 8 deals. So you're right. We can't take on every deal that walks in the door. And that's true of most investment banks. That is not true of most business brokers. They will
put the listing on. Ready to go.
It's a different approach. And I don't want to talk negatively about the business broker approach because I actually think it's appropriate for certain deals. Right.
I do too. But, which ones do you think? I mean, like,
so if you have like a single location franchise that's worth $200,000, like we can't spend $500 on your transaction, right? Like a business broker spending a couple dozen hours to see what the buyer universe looks like actually makes some sense because they might only charge $20,000 for a fee, right? And it's like if they just can't.
You really think so? Well, that's 10%.
So yeah, call it 10% of the enterprise value, right? So they might be at $20,000, and you just can't spend that much time if your fee is going to be that. So I do think their approach makes some sense at the lower end of kind of the Main Street market, where I think business owners need to differentiate between a business broker and an investment banker. Is once you approach $1 million or so of EBITDA. There are good investment banks, and we're not the only one. I think we do a good job, but there's others that are serving that market as well. It's like night and day. Like for example, and I know you already have a podcast.
Well, I mean, before you hold that thought, because like for the listeners, and like you get to is this a fair statement, Adam? Is like once you get to $1 million in normalized EBITDA, you're looking at the company as an investment. And understanding what the leverage ratio is and how someone can buy it versus like you get below $1 million in normalized EBITDA. And I was just on the phone with Luke Mappin, contact our friend.
Shout out to Luke.
Yeah. And like, you can't fund these deals. So you have to like get into seller's discretionary earnings where someone has to buy a job. So there's like this weird, like underneath $1 million. Is that a fair?
I think that's a good description of it. And then the lines get a little fuzzy, right? As you approach $1 million, it's not like, don't get me wrong, $1 million isn't like a hard line in the sand. It's fuzzy and it's depending on the industry and the deal and the dynamic.
Well, and it depends on the deal structure of the debt, the equity, and how all of that transition of the cash flow is going to happen. But that's where the art comes into what you do versus just like slapping it on a website saying hopefully people come knock on the door.
Yeah, correct. In fact, we don't even think about what a good fit for Quazar is in terms of size. I mean, that's one of the factors, but our driving determination on are we the right group to help someone sell their business or not is there a pool of healthy strategic buyers that we can market the opportunity to, and we believe we will be successful in getting multiple offers from that buyer pool. If the answer is yes, it's probably a good deal for us. If the answer is the buyer is probably an individual who wants to buy a business and run it themselves, and
it's a needle in the haystack.
Yeah,
almost.
that's the only kind of buyer pool, then we're usually not the right group. So that's in my mind kind of how I
So let's pull that thread, because I think it'll be helpful for everybody to know how you find that pool. But let me know if I'm on track or off track with okay, you with the difference, just to everybody go back and listen. But like, you've got effectively the business broker is more like real estate. And then you've got yourself, which I call it, whether they call it the controlled auction, but you're building the funnel. You're saying, okay, there's 300 people. We need to get the qualified people. And then you get the NDAs, the LOIs, and you're saving time for the owner owner operator who's going to be running the business. And you're creatively looking at the deal structure, the taxes, the whole, and you're not a tax mitigator. I'm just saying, but you're looking at all of that stuff versus, do you want to sell your business to someone else? And I say that because, let me know if there's anything you want to correct on that, or if I'm off. But then also, that takes time, which is what your fee gets paid for. But then two parts of this is, where do you find those buyers? So for these people, okay, Adam, great. I can pull out the internet, and I know 5 people in my industry, and so that, and then I want to talk about the deal structures and the loss opportunity of not using an intermediary.
Yeah, really good question. So again, I think there's kind of 2 marketing approaches to selling a business. One's a passive approach, where you're generally using listing sites and you send out an email blast and then you see what comes back, right? The other approach, which is the investment banking approach, that's an active marketing approach. So that's what we do. We don't even use listing sites. We found those are a good way to find bad buyers. So
yeah.
So what we do is, we keep a database, and we spend a lot of time on this database. It's a really, really big deal for our business and our industry, what your database looks like. So every single day we're working on our database. In that database are buyers that we've talked to. Oftentimes we get networked to them. Sometimes they're cold kind of inquiring and telling us, hey, I'm a private equity group out of Tampa Bay, Florida, and here's my criteria. Well, we make sure they're in our database. We make sure we kind of have the right check boxes and ranges in there,
where they got their fund, what their investment profile is. I mean, so is it a fair statement? Is it just a CRM, right? You have a CRM.
Yeah,
of people
we use Salesforce. It's a CRM, but CRMs are only as good as you make them, right? Anyone can have a CRM, but they can be somewhere between worthless and extremely valuable. We try hard to make ours more on the extremely valuable side. So we have our database. That's something we work hard on. But then for each one of our deals, we curate a custom, we call it a buyer's list. And to your question, how do we create that buyer's list? Well, we subscribe to many, many software tools, and these aren't Reference USA that you can use at the library for free. These are 5-figure subscription services, and we subscribe to a lot of them. In fact, when I look at our expenses as a firm,
yeah, I'm sure it's a lot of it.
Payroll is our number 1 expense. Software is our number 2 expense. Mm-hmm. It's above rent. So it's a big deal, right? And then we are trained, and we train our folks here on how to use those databases, how to query the right things within those databases. So that allows us to come up with a list of what we think are strategic buyers, and we think in terms of synergies when we pull those buyers lists. So in my experience, if you own a business, your direct competitor who operates in your market doing the exact same thing is probably not a very good buyer for your business. So what we do is we just
that happened to be our exit, but that was I mean, we didn't use it, but I know I'm not calling your shit, but it's but also it's why I've been doing what I've been doing for 10 years, dude. So so take that for a grain of salt.
No,
right?
no, that's a good point. And it's certainly not always true, right? But I have found the best buyer is someone who doesn't quite do what you do, but wants to, and knows about how to do it. So maybe they're industry adjacent, maybe they operate in a different geography, maybe they're doing the same sort of stuff, but they serve a different vertical. So in those are how we think about synergies. So we come up with a list of buyers, and some of those buyers are privately held businesses, some are publicly traded, some are private equity groups, some are private equity backed strategics. And we categorize our list and organize them accordingly. And then we come up with a list of usually a few hundred companies that we think have a strategic angle on buying the business.
So is it a fair statement? So like in my workshop, I break down the types of ownership structures and exits, and like, because an ownership structure is just the intent of growing equity and cash flow for another entity or another shareholders, right? So there's just this, it's the Pac-Man game of capitalism. Like you're just fitting into someone else's cash flow and equity, or you're doing that to someone else. And so if you have private equity, you're either going to be a platform for them or you're going to be bolted on to. So that would be like private equity backed strategic, like you said, right? And then with a strategic, the way I put strategic is like it's an entity that's, geographically or, vertical or horizontal, but it's an entity that has an acquisition as their strategic initiative for their growth. And then you've got like family offices and shit like that.
Exactly. And sometimes I agree with what you said. I would just add, sometimes the buyers we're reaching out to may not have acquisition on their radar, but it's part of our job to convince them that they should, right? So,
okay, let's pull that thread, because like that means they don't know what the hell they're doing.
Sometimes.
So how do you navigate that if you got a big company that everybody thinks is sophisticated and they have no idea? Hey, like maybe they have a huge lending ability to go borrow, or borrowing ability to go buy a company, but like, how is integration going to work after post acquisition? What's the new org chart? I mean, like, so how do you navigate that fitting together? I think we're kind of staying on your synergies.
Oh, it's a great question. It's through conversations. It gets back to the active marketing approach, right? We're not just like listing and praying and signing a letter of intent. I mean, we're having conversations with these buyers so that different buyers do have different sophistication levels. And if they're not sophisticated and haven't done a deal before, that doesn't mean they're a terrible buyer. It does mean we're probably in for a bit more hand-holding. It does mean the team around them, so their attorney, their CPA, it's important that they have experience, right? And through those conversations that we have, we help vet that out and we advise our clients accordingly. Because ultimately, fit matters a lot, valuation matters, structure matters, but also when you're doing a deal, certainty to close matters a lot. I mean, we could have a
for you, yeah, for sure, and everybody's time.
I mean, not just for us, right?
I hear you, but like the time,
but for our clients as well. Because if you go down the path and sign a letter of intent and the deal breaks, and then you got to put a different deal together, it is significantly harder than the first time around. Because then you got to go back to buyers, and they know something happened, and they're less kind of willing to be aggressive with valuation structure, timeline, all that. Mm-hmm. It's not impossible. I mean, we've done a couple of those actually this year. But it's not ideal. So we kind of do everything possible on the front end to make sure, either we feel good about this or we don't feel that good about it, but maybe there's reasons to take a flyer on it anyways. We advise our clients, and ultimately it's our client's decision on what path they want to go down.
So you broke those down in a couple buckets for synergies, for like, it's a good fit. And I want to unpack a couple of these, Adam, because I think it's really important for people to listen. It's not like, I'm going to sell my company for $15 million and Adam wants to buy my company for $15 million. And we both do similar things. Let's get a deal done. I mean, like, and that's where there's so much of that crap out there. And so like, here's how I think about this. Like, and I'm curious on how you deal with this with your clients and the marketplace, because like for me, dude, like I can see like hand glove on like the strategic fit of companies. Like, okay, so like, I'm just riffing here. I'm just talking out loud or thinking out loud, but like, okay, so I can see like strategically this person and this marketplace with this product pricing fit, and like, great. Okay, this thing could be beautiful together. Okay, now insert in the sophistication and awareness of the buyer and seller with what the hell we're talking about. And you could have like both, no idea what's going on, both completely aware, which is like, hey, we're both playing 4D chess. Isn't that awesome? Or one's playing 4D chess and the other one's playing checkers. So you have the sophistication nuance, and then you go down to then the people nuance and the cultures, and then you go down to the deal structure, which could be all cash, half earn out, half cash. I mean, like, and then like, the reason I've chosen not to do what you're doing, because that would drive me insane. Trying to do all of that, and so and then trying to explain.
I mean, it can be infuriating. It can also be extremely kind of intellectually stimulating and rewarding, right?
And psychologically too, right?
When we know that a deal came together, kind of because we helped put those pieces together, it is so awesome. Like it's really
the dopamine has to be worth it, otherwise you would go insane. Right?
It is so fun. Yeah, it's really fun. But you bring up a good point. The good news is an investment banking process kind of tries to vet that out throughout the process, right? So
because you don't want to deal with it, right? At the end of the day, and you're trying, because at the end of the day, if you don't want to deal with it, because you're trying to align your effectiveness of time to closing a deal based on the fit for everybody.
Yeah, exactly. And the fit, your funnel analogy is something I use in all of our pitches, because I think it's a really good way to think about what we do. But it's not just narrowing it down, it's narrowing it down in a logical way where you determine some of those things. And on structure, we are advising the buyers what structure will be most favorable to our clients. It doesn't mean we always get it, but we do have some control in terms of, hey, our client is not going to sign an LOI unless it's 100% cash. Factor that into your valuation, right? Sometimes our clients just won't take structure. Sometimes they're open. Sometimes they want to roll equity. And we can advise the buyers accordingly and ask them to bake it into their valuation.
Well, so I want to keep heading down that road for a second. So, subject to spending 3 hours of me and you just ranting about a bunch of different technical things.
I can do it all day.
Oh, I know, me too. Not only me too, but I have for a long time. And then I realized that, wait a second, no one's paying attention. And this is
that's true. That's a good point.
But here's what I'm trying to get across is okay, when I think about the analogy of the capital markets is 4D chess, which is an intellectual freaking blast to me. But then it's not sell a company for $15 million. Someone buys a company for $15 million and it's either debt or cash. I mean, that is so far from the truth. And here's where I struggle with, and it's the deal structure outside of, okay, let's take strategic, operational fit is perfect. Culture fit is perfect. All of these different things, we've checked the box, and now you just get to deal structure, and you're okay. Adam, years ago, I did a podcast called "You Tell Me the Price, I'll Tell You the Terms." I'll buy your company for $100 million, but it's a 1% interest rate over the next 100 years. And so here's what I'm trying to get at: is net adjusted working capital. If anybody listening and knows what that is, they're probably in the single digit percentile. And so that right there there was just one guy that I convinced to use an investment banker, and that swing was $3 million, and they didn't know what it was. And they were trying to use an M&A attorney because they got the out of the blue offer. And I sit there and I go, I know why the hell you should reuse an investment banker, but they're like, Adam's going to cost me $1.8 million. And I'm you're an idiot if you don't do that. So I don't know where to go with the deal structures and how to prove it. And what I'm trying to do is help the owners going that alone, or asset versus stock sale, 338 H10 election, or all of this shit, dude, C Corp conversions. I mean, how do you describe?
There's all sorts of moving parts to these deals. And look, us in conjunction with the rest of our clients' deal team, so attorneys, accountants, our job is partially to educate on some of those things. With that said, we've closed deals where I guarantee our client could not tell you what working capital is, right? They just, some of these things are just not going to get through at the end of the day. And that's kind of okay if you have the right team around you.
If they blindly trust you, not blindly, but if they trust you
enough where it's let me take that.
Let me take back how I said that. It's not blindly trust you, but what I want for everybody is to get to a comfort level, like I just did with this new doctor my wife and I hired. He's not a pharma rep. Yay, finally. You know what I mean? I am finally comfortable letting go with, you know what I mean? And that's what I want for people. They've done enough education to let go, but how to get across to someone that gets an out of the, I got a client right now, $26 million out of the blue offer. She's I don't know, maybe we should just use an attorney and a CPA. I'm oh my God. is this the right buyer? What's the right deal structure? I mean, we're going to spend 6 months. The anxiety goes through the roof for me.
I mean, in that scenario, here's what I would say. And I think I've said this to you before, but if you own a business and you get an offer out of the blue, just what are the odds that one buyer who happened to call you is the best fit and is going to offer the best valuation? I would argue the odds are near zero. I mean, it's just very, very, very unlikely. And let's focus on the 5% that maybe it is the best buyer, the best offer. We can always add value directly to the deal through negotiating. We just always can. Like, if you get an offer, there is a better offer that buyer is willing to sign. There just is. Like, they're probably willing to come up on valuation. They're probably willing to deal with structure and make it more favorable to you. And by bringing in an investment bank, not only do we kind of know what's market and how to have those conversations, but it also signals to that buyer, you're serious and you have other options, right? Because a group like me is going to tell a business owner, that's fine if you want to focus on one buyer. We'll do what we can. We'll put together a deal. But if things don't go how we hope, we'll pivot and we'll just go to the market. We'll go to other buyers. And sophisticated buyers understand that. So just by bringing in an investment bank, I would argue just by doing that, you are going to more than pay for the fee just because of the optics of
the buyer's going to be like, they're freaking serious, and you don't have an engineer.
Exactly. And it's kind of scary to the buyer. It's like, oh geez, like now they're advised by someone who knows how to contact other buyers, who knows how to market.
So I 100% agree with you on this. And like, here's where I think that it's a no-brainer. Terms and conditions of deal structures and freaking employment contracts, non-solicitations, holding the line on the actual enterprise value during due diligence, navigating due diligence, like all that shit is like a no-brainer. But it's so frustrating to hear people go, well, it's going to be, and they say the dollar amount of your fee of a couple percent on, or whatever, the few percent on the enterprise value. And they literally, it's this unawareness of how valuations work. And if you and I did not know what this iPhone was worth and have a market value of it, how in the hell are we supposed to trade this back and forth? It's just insane.
No, you're exactly right. And we get pushback on fees all the time, right? We're not a stranger to that. The way I view it is, that's our job to articulate to business owners why we more than pay for our fee. And if we meet with someone and they walk away questioning the fee, we have failed in that conversation.
Fair enough.
We haven't done a good enough job, right? I don't view that as the fault of business owners. That's our job, right?
Okay.
Business owners, their job isn't to like know what we do and know the value we add. It's our job to explain that to them. So yeah, if we never get,
if they're lucky enough to be one of your 8 deals a year, though, like the problem is everybody else is just willingly to take on a business owner who doesn't understand. Like it's the education and the lack of understanding of value and how valuations work that makes this marketplace so inefficient. It's absurd. And the people that get hosed on it are the people that created the goddamn value. It's just so frustrating to me.
No, I mean, that's why what you do, Ryan, is such a service to people. Like, you make it digestible in terms of how to create the freedom that they want, be it an exit and be it what type of exit and kind of how to do that and the things to focus on, right? Like, you're telling people an actionable plan, not this finance theory.
Well, like, how do you create cash flow? And then, because at the end of the day, like the way I view it, Adam, is like someone should, they should be running their company like a private equity firm in a family office. Like, why would you want a job? Why wouldn't you just have other people do it for you, kick out the cash? And it's really, really hard to do that, but the reward is freaking off the charts.
Well, I think what you just said is why people tend to not do it, right? It is hard. And you have to spend extra time on things. And it's like, a lot of business owners started their business because they know their industry and their market really, really well, and they're really good at what they do, and they've built it over time. But this other stuff that we live and breathe is just not in their wheelhouse, right? So that's why it's good. Like, you're talking.
I agree with that, but then also how many horrible advisors are out there that get suck off the cash flow of the people that created the value, because they say blah 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 blah, working capital, this that, whatever freaking acronym they throw at the owner, going, yeah, I guess I do need you. And it's just it's so synonymous to the healthcare system. That's a dumpster fire. Like, wait a second, I have a new knee, I didn't need one, and I actually just needed to go for a walk every day.
Correct. I totally agree, and it is. Again, I view this as our job, but if you're a business owner and you meet with 10 people like me for an hour, it is pretty hard to differentiate who is doing a great job and who isn't doing a great job,
Because you could be saying the same stuff.
Yeah, similar things, and we're all probably pretty likable and right, but so we focus a lot on that. How do we get in front of people for 90 minutes and they walk away with here's what they do, here's how it's different, and hopefully they like us, right?
Yeah, so let's I appreciate that. I'm sorry, I think we've beat that horse about how important this is, but I think let's continue on the education, the deal structure, because when you were talking about it's hard work, but hopefully the people listening in are usually willing to do that hard work, or at least they're educating themselves to what kind of hard work, because I never hold it against people where if someone decides hey, I have an idea I actually have a better realistic understanding of what I would need to do to get this place to the point where I can step back and keep it, or to the point where I could sell it. And they're I don't want to do that. Good for you. It's a clear decision, but it's I will never judge someone for that. But I think, but they have this trade-off of understanding the value creation and the time. That's all we all want, is to say, okay, am I spending my time on the right things to create the value that I want? And instead of hoping. And so this goes back to then valuations and understanding them. And this is not about exiting. It's about building an asset and doing the things that you can do. And then eventually you're going to have to monetize it, right? That's where you come into play. You're helping people monetize that asset when and how it makes sense for them.
That's really well said. Yeah. When we have successful outcomes, sometimes our clients thank us and say, you got me so much money. And my response is, we didn't do it. You did it by creating this asset. And we just told the story, right? We were the negotiators and the logistic people, but you did it. And I believe that. And you, Ryan, you help people do it, right?
So let's talk about how you tell the story. And I think you just said something that is what is paramount to my preaching, is I am convinced all those workshops you've been to, every one of those owner operators can tell an amazing story about where they've been, where they are, where they're going. And they've done really hard things and they've created value. And then my first question is, prove it. Right? Prove it. You seem like a wonderful person, Adam, prove it. So that is the story. Cause you're going to believe someone, but then you're going to go look under the hood. And so let's talk about how value creation and it's all part of the same game of capitalism. And so what is it that you're looking for just for yourself to say maybe we go back to the deal that got away, and that's how you think about, when you go take someone on, what are you looking at for that they can prove it, so that way you can tell the story and prove it? Is this a fair way to kind of categorize or put a wrapper on that?
Yeah, I think that is fair. I won't go into finance theory too much, but I think it sets up my answer. The value of a business is essentially driven by two things. The cash flow it generates and the quality of the cash flow.
And you mean the future cash flow, or
the quality means a lot of things, right?
Yeah, right.
It means the future. It means the stability. It means concentration levels. There's a lot of things that we could kind of unpack on the quality, but so the cash flow kind of is what it is, right? We can explain the whys and things, but our message and a lot of the value we add is around the quality of those cash flows, right? And there's all sorts of qualitative factors that go into that, and that's a lot of the story that we tell when we're representing clients, right? In terms of how do you bring it to the next level? Why is it not going to go away? What are the risk mitigators if there are areas of risk? All those things are really, really important to unlock value for business owners. And that's a lot of the value add. And buyer, and you often hear that reflected in the multiple, right? You'll hear multiple.
Yeah. Well, and I just, for the listeners, and they can go back and check out the Ken Sangenario podcast I did on the 8 functional areas, and we spend an hour and 45 minutes talking about the multiple and the weighted average cost of capital and cost of debt. So like you can go until you're blue in the face, but I think what's fascinating, Adam, is all of this is so leveraged because you just said that you are trying to tell the story of the quality of the cash flow, right? The cash flow is, I mean, as long as you can prove the normalized EBITDA, right? So there's a whole set of like,
yeah, I mean, that's a whole thing in itself. You're right. But like,
you got to have the normalized EBITDA and the numbers broken
assuming
up.
That's right. It kind of is what it is. And
huge assumption, but
we need to be able to defend that, right? That's
right.
a part of what we do. But like most of what we do is talking about the quality of the cash flows. And that, sometimes we meet with business owners and they're like, how do my 50 years of business get reflected in the valuation? And I would argue it's reflected in the multiple via the quality of your cash flows, right? And like, but that's part of the story. And when we're talking to buyers, they don't want to hear a finance lesson from us. They want to hear a story, right? And they want to get comfortable with the business. And that's what we do.
Have you read the book Branding for Buyout?
I have not. No.
Oh, dude, Ted's the man. You should talk. Ted is a marketing agency that he's in the upper part of the market, Adam. Okay. But like he built an entire book where like he has a marketing company that brands for buyouts, all about storytelling. He'll like run Facebook ads and beat the shit out of buyers with Facebook ads. I mean, it's like next level, dude.
That's pretty cool.
Branding for Buyout and branding. And anyways, a couple books there. But going back to your point, and like so Ken Sangenario's value opportunity profile is super fascinating, Adam, because those 8 categories of value drivers he calls, it's not some made up fluffy idea. Like what Ken has done, I'm curious, have you ever seen it before? Oh, dude, like
I feel like
have to go back and I've known Ken now for 7 years or so, and he's where I've got a lot of the data from the U.S. Census Bureau of like, hey, where are these size companies? What's going on? I've learned a lot of this stuff from him. So here's how the system works. He was a turnaround consultant for like 25 years, public company CFO. Like Shannon Pratt, who was like the founding, valuation guy, said like Ken could potentially change valuations. He's just still stuck doing a lot of work. And I'm like, dude, you have this material. So it's 8 functional areas, and he's got this questionnaire, Adam, that he's got 2 different levels of it, call it like 300 questions, but on each function. So sales, marketing, finance, people, ops, legal. I don't know what the hell the last one is. Anyways, all of these, you have these questions, and it's your due diligence checklist. Like, do you have a professional management team? Like, do you all of these different things? Each of those functional areas roll up into a score, and then those roll up into one risk profile that's tied to the weighted average cost of capital. That's tied to the WACC.
Cool.
Yeah, and the multiple. So I'm saying the reason I'm bringing this up, if someone does that, I'm like, dude, like Adam could tell your story if you had that. Not only would you know what you should be working on every day, but like if you were to hand that to Adam could use that as a freaking story to say, this is what the next buyer should do if you want. So like how many people have that type of?
No, almost no one. I mean, just to be open. I mean, once in a while we get a very sophisticated client who like they might not have it exactly laid out that way, but they think about things in those terms, right? Like we don't do a ton of private equity sales at Quazar, but we have one private equity client right now. They're super buttoned down on that stuff. They're very organized.
Like you mean private equity sales where you're selling the private equity?
Yeah, where we're selling a portfolio company of private equity. Right. So in those cases, private equity is kind of more buttoned up and has a lot of that done. The vast majority of our clients are family-owned businesses, privately held businesses. In those cases, we at Quazar, we have to craft all that story. Right. We ask a lot of questions. We sit down for meetings, and we come away with our way of driving the narrative with buyers. But yeah, I don't think we've ever just been handed what you just.
Yeah. Like what if someone handed you a 3-statement forecast and the 8 functional area, like risk profile with the valuation, the future valuation?
Yeah, I mean,
what would happen?
It helps value, right? Because like buyers are going to know it's not just something we made up at Quazar. It's like, no, this is actually like how the business thinks about it. B, it's going to condense our timeline. I mean, our process takes 6 to 9 months, and usually it takes a couple months to get all of our stuff together. If we're handed all that, we might be able to get out to market in 3 to 4 weeks. right? So like that would be nice. And then I assume our buyers who are often in the meeting, or our clients who are often in with the meetings with buyers, they're going to be able to speak to things much better than often our clients can, right? So yeah, that would be fantastic. That would add a lot.
Which is okay, so here's what just boggles my mind, dude, is like without that. So like, and I want to talk about like you've done like what almost 60 deals and like what you've seen, but like before we get to that is like, because I think there's a lot of, and I mean, like you and I are spending so much time talking to these people, like it's anecdotal, but I think there's some good insights to be pulled from it on trends and stuff. But like, I go, okay, so it's October when we're recording this. Everybody's going into their annual planning, Adam. I don't know what the fuck anybody does.
Well, and are they, Ryan? Like a lot of our clients they don't do budgets. They don't do annual plan. Like it is not like it is more uncommon than common. Like it just
even so. Okay, like maybe that's okay. That's even like a short sighting that I have is like. So where I'm going at, where I think it's just completely effing ridiculous, is like, okay, everybody's gonna hire their EOS implementer for $7 to $9 grand a day, or I don't know. So it's 18 grand for 2 days. I don't know what it is, but like, so it's like we're gonna create this VTO, which by the way, I absolutely love an operating system. But the definition of an operating system is when you and I sit down at a computer, we need to know what the hell we're doing and why before we use our computer.
Correct.
Because like if we go in there and look at porn, it's going to go to porn. If we go there to a spreadsheet, it's going to go to a spreadsheet.
Yeah.
And so like, and I go like, okay, so like people are sitting down in these meetings, they're making up these strategies, some more insightful than others. Maybe someone's done a strategic plan with a SWOT analysis and a BCG matrix or whatever the hell. But like, it's like, okay, if you got $1 million in normalized EBITDA, 200 grand, 300 grand in taxes, depending on where you live, 200 grand in distributions, you have $500,000 left. How many people know going into annual planning how much money they have to invest next year and how they're going to tap their line of credit and what the effing return is going to be? Instead, it's like, I know, like, well, I can't, like, I just think about what my dad and I did. It was like, we were making shit up all the time on a $20 million business.
If there are forecasts or budgets put together, oftentimes that's what I see. It's kind of like, hey, Ryan, what do you think we're going to do next year? Well, 5% more. Okay.
Divided by 12.
Right? Like, I mean, that's kind of how the discussions go.
Well, like, and Adam, it's crazy because like, if you're going to buy, like, if you got $1 million in normalized EBITDA, times it by 5. Like we're not like, let's 5 multiple. So you actually get down in like, and I know normalized EBITDA is how the valuations work, but like for free cash flow, that thing might have 700 grand. And then you go, okay, well, 700 grand, like on a $5 million SBA loan at 10% is 70 grand a month in debt service. So what about working capital? Are you going to grow the company? Do you need any distributions? It's insane what people are doing. And I'm sitting here going, this is why I'm going like, I just don't get it.
Well, that's why.
What am I missing?
Well, that's why you've been successful doing what you do, because there's a need for it, right? Like,
but like I appreciate that. But where I'm going is like, what's made me insane is like how much of this shit I've been watching, where buyers are coming in, and I'm like, what did you just? You took out a 10-year loan on their company, and so like what's the sustainability of that 120 months of $70,000?
As someone who would usually represent sellers, buyers should always pay more, Ryan. They should pay more. They can get a 100-year loan. I don't care how they do it.
I know. But here's where I'm going with this. Okay, going back to the annual planning. This is how I'm trying to hear from someone else why my thinking is wrong. And like, all I can think about is if someone goes into annual planning, how much free cash flow do we have? Or, depending on funding sources, but like the funding source decision tree will impact your equity or your debt. Like, how much cash flow do we have? How much do the owners want? Has to be done. Private equity doesn't go in there and go, what should we do, everybody? Like,
correct.
Like, here you have $500,000 next year. What are you going to spend it on? ERP implementations? Are you going to? And this is where the 8 functional areas comes in. This is why I'm kind of trying to loop this all together. Yeah, Adam is like doing what is going to make your job easier and make the company more valuable and make it more marketable is actually what allows them to not freaking guess while they're doing their planning. And I'm like,
I mean,
why wouldn't you do this?
You're right. You're not wrong. I can think of reasons why people don't do it, right? They don't know. Like no one ever taught them, right? They don't like, and B, they're busy, right? That's what we hear from our clients all the time. They're just.
Is it busy because, okay, I'm sorry, I'm keep interrupting. It's like, are they busy because they don't have any time, because they don't have enough distributions, cash flow?
Yeah,
yeah.
I hear what you're saying. It very well could be, right? Or they're focused on maybe the wrong things for their role within their business. That's something we see all the time.
I just look at it and go, like, there should be like this VOP type of value growth strategies. Like, where are you going to spend the money? Put that and tie that to the KPIs of EOS and roll that all into a 3-statement model. And then, like, you should just like it's just this constant clip, and the owner doesn't have to be the expert in all that stuff. But how in God's name are you like selling these companies when people come to you and say, yo, dude, I've had this company for 30 years. Please package it up.
I mean, obviously, if someone comes to us, they're like, we need to sell tomorrow. It's not an ideal situation. With that said, we can usually work with what we have. And how
much will you explain your process of working through? Like, okay, so because let's say you found the ideal client for you. Like, and I'm assuming it says like they're not desperate, like this is actually marketable, but like, how do you end up building that story?
Yeah, so it's very deal dependent, right? But generally, we're going to look at their financial statements. We're going to better understand their business. We're going to understand the trajectory on where they're going and what their goals are. And once we kind of understand all that, we can usually make a recommendation in terms of not only the value today, but where the value might be 1, 3, 5 years from now, and where on that continuum we think is the right time to actually hit the market. Because timing is really, really important.
Interesting.
It's really, really important, right? So sometimes, and we're meeting with a great business next week, actually, that's doing really well, but next year they think they're going to do way better. And our recommendation is going to be, given they've told us they don't need to sell now, don't sell today, even though I think they kind of want to, but they're going to unlock a lot more value by booking another year. And we come across.
How do you think about timing? Like, is it timing for just based on the cash flows, or do you have any like thoughts about like economic timing, or is that all?
Yeah. I mean, in our standard pitch deck, we have a slide about this, and we have these 3 circles, and it's a Venn diagram, right? And then the middle is sell, and the 3 circles are it's macroeconomic considerations. So like if we're in the middle of a recession, right? If it's 2009 and you don't have to sell, you shouldn't sell. Like you're just not going to unlock maximum value unless you're in some like niche industry that's benefiting from the circumstances. So that's one of the considerations. The other consideration, the second consideration is business performance, right? How is your specific business doing? How has it done over the last 12 months? Where's it going over the following 12 months? And then the third one is your personal goals and objectives as a business owner, right? And my advice to business owners, which I think is right, is try to get it close. Like you're never going to sell on the perfect day to sell your business, right? Like, but hopefully your goals and timeline and what you do with your life, you can kind of get it plus or minus a year or two. And while you do that, you want your business to be performing pretty well, and you want the economy to at least be doing decent, right? Like the economy right now, it's a fine time to sell your business, right? And that, again, it's dependent on what sector you're in, but like, so you kind of want those 3 things to align, but no, you're never going to like get the perfect date. That's impossible to do.
Yeah. And just to reiterate, we're talking about third-party sales here because in ESOP, internal transaction, all that.
That's my word.
Yep. I just wanted to make sure.
Yeah, exactly.
I know where people's heads go, and I'm just trying to make sure they're staying on track.
Yeah, there's a bunch of ways, as you've detailed on other podcasts, there's a bunch of ways to sell your business, right? What we specialize in is third-party sales at Quazar. We will do some management buyout work and things like that. But like, if you want to go ESOP, we're not like the right guys for that.
Yep. So let's talk about back to kind of like your Venn diagram. And I think this might tie into why do people come to you to wanting to sell? What is their level of understanding? Because I just want to hear from you so the listeners understand kind of what normal is. But then before we get to that, and I can restate that question in a second, but like, where's it going with this is, you're talking about that Venn diagram, someone's personal goals. Here's how because I take it a couple layers down of nuance. So like, what the hell you want to do with your job? Because like the dependency on you, like strategic buyer versus private equity platform versus private equity bolt-on versus like, wealthy family office, like every one of them will want a different level of your involvement potentially. So you have the job and then there's the purchase price. And I'm trying to separate that stuff for everybody. Like, how do you think through that? Because like, what if someone said, Adam, I got another 3 years left. I just don't want to do the oversight of like the CEO admin shit. I just want to be the visionary culture strategy. How do you fit that role and the deal structure together for people?
It's a great point. I mean, in that scenario, I would say like, hey, how's your business doing? Where is it going? And also, have you really asked yourself the question how you're going to be having a boss, right? Like like once you sell the majority of your business, even if you remain the CEO, you now have a boss, and that's not for everyone. I mean, some of our clients do fine with it. Some of our clients hate it. So like really do some self-reflection around that because it's not for everyone. So I guess that's how I would answer the question around like, but that is a good. I will say that's a great scenario though, right? The flip side is, I think you've heard me tell this story before. We sold a business where the owner had a significant health event and probably didn't have a lot of time left and came to us and said, I never wanted to sell my business. I love my business. I love what I do, but like, I got to get my affairs in order. I need to sell now.
Oh, that's so sad.
And
yeah.
like, well, that's pretty sad. But good news is where there's cash flow, there are buyers. So even though we didn't have time to like structure it and prepare it and things like that, we did get a successful outcome. But the buyer met with him. They knew the circumstances. It was a private equity group who like openly I didn't love working with. And I do think they kind of stuck it to us on a couple things at the end. They had some strange asks around working capital at the 11th hour. They had a strange structural change. And usually we'd push back on that stuff and threaten to walk away.
Should have time.
We just weren't in the position to do that. So we just ate it. We took it. We got the deal done. Our client was still happy, but I think about that a lot in terms of like, if the circumstances were different, I think we could have crafted a little better outcome.
Well, and that's a good example of the worst potential outcome, honestly, for a human being. But like, I'd say almost everything you just said, I see as applicable to someone that has run out of energy.
Fair point. And we see that all the time. And to answer your initial question on this, Ryan, the most common circumstances we see, so business owners listening to this, don't think like, oh my gosh, I don't have a 3-statement model, I'm way behind. Like
I'm trying not to make people feel bad.
Like the most common scenario is we meet with the business owner. It's usually 1 to 3 shareholders, and most of them want to retire soon, and they've never thought about this stuff. They don't know what their business is worth usually. They don't know what a process looks like. They don't know different types of buyers, right? And that's all okay. Like we can usually work with it. It's not ideal. Ideally, they've been working with you for 5 years and then they sell. But like, so that's our most common circumstance is business owners really don't have any knowledge about the M&A process, valuation, structure, any of that. That is, I'd say 2/3 of the time.
It's hard for me to describe the pit in my stomach when you say that, because it just brings me back to 11 years ago and I want to bang my effing head through the wall. and it's truly out of like, it might sound like, I don't know. I've tried to reconcile this with like my emotions and stuff like that, Adam, over the last, decade, where like, at first years ago, it came off as resentment towards like the marketplace and advisors, and that wasn't suiting me well, and people didn't enjoy that for the right reasons. And then my passion becomes like if I were to see someone unhealthy or not being happy, and knowing that they had the potential to be happy and healthy, and watching them do things that are not getting them towards the full potential of what they could be, that's where like it just like breaks my brain. And so like, and I just I think like like the wave of freaking older people coming to market is terrifying to me, Adam. So like, let's talk a little bit about macro, and then I want to talk a little bit about also. I'm doing this maybe for both of us. Of like, I want to make sure I don't forget this. Of like, what I think a perfect rhythm would be of an owner operator and someone like how they're touching base with you. But I want to make sure we kind of get to that. But like, I want to talk about the macro for a second, Adam. Is like, so like, the Exit Planning Institute, and you name the wealth management firm in the country, or the CPA firm in the country, or the law firm in the country, or the business broker firm in the country, and it's the $10 trillion baby boomer wealth tsunami. And I literally just want to say bullshit. Like I have all like, I look at the Census Bureau and I go, okay, well, there's only 4% of companies are over $1 million in normalized EBITDA that could even fund a buyout. So like, what am I missing, everybody? And no one's explaining this to me in a way that makes it. I'm like, well, so there's a lot of owner operators that have jobs that could get value. I'm not poo-pooing $1 million or anything like that. I want to put this in context, but like when the person needs 3 million to retire, it's a problem.
Yeah.
And they're tired. So like, what the hell, man? Like, are you seeing that? Cause you and I we've known each other for 8 years now. And like, I say like, 10 years ago, I was 28. Now I'm 38. And I've watched people go from 55 to 65. And that's a big life stage change. And like, are you like, how do you digest what I
can relate. I went from 32 to 40 and my back hurts now. So like, I get it. But I hear you. Like, some business owners may not have enough value in their business to do what they want to do in retirement, and hopefully they don't discover that too late. For the fortunate ones that do, can
I pause you for a second? Sorry, I hate to do this. Before you keep going, like, but the problem I see, Adam, is how many. So I don't think we as a country can actually poo-poo this shit, because 4.2 million boomers are retiring this year. And then you like, so the brain drain on corporate executives and public companies is something that's talked about on shareholder meetings all the time. And so like, I just look at this, Adam, I go, what does this mean? Like, you know what I mean? And maybe I'm just too big picture. No, I mean,
it's a great question. I will say one observation I've had that's relevant to this discussion is the average age of our clients who are selling because they want to retire has gone up since I've been doing this. Like, I think, maybe 20 years ago, business owners would hit 65 and say, all right, it's my time. And we're not seeing as much of that anymore. Like, we're seeing a lot of clients in their 70s. A lot of clients in their 70s.
They're about ready to like go into the next stage of run for president.
I think they gotta be in their 80s. They gotta be in their 80s for that.
Got it.
But the whys, I'm not the right person to ask on that. But I do think baby boomers who own businesses they're working longer than other. And I don't know.
My question, do they need to? And this is what
That's a great question. I don't know the answer.
Okay, yeah, and because this is where it's backing into like the person that's making 250 grand. And you could back into the cash for the size of the company for 20 employees. You go like, they have to have $3 million saved outside the business if they want to maintain that income, and they're going to net $1.5 million. And I go like, the math equation doesn't math. And then they're tired. And then I call it the 3 multiple hamster wheel. So, okay, if I sell for $2 million, debt and taxes, I make $1.2 million. I keep this thing for 3 more years. I still have, but then you go from 65 to 66 to 67. And I'm watching that every year. You layer on 4.2 million people every year. I mean, like my college buddies and I were talking about this. All of our parents are now the grandparents. And we're like straight up in the middle. Like, we're now the parents with kids going to baseball, you're coaching basketball. And it's just interesting for me because I still work with my dad. We're like, I've watched this whole thing unfold. And I guess my only why I'm on this monologue is like, it hurts me that there's going to be so many people that have worked for 30 years not have the opportunity to ring the bell or get what they one. I guess that's my only
I
2 cents on it.
no, I think that's well said. I just think like I wish people kind of had a better grasp on the valuation piece. There's a bunch of things to learn, right? But like if you own a business and you're planning for retirement, like just figure out kind of the rough value of your business. I think that's an easy thing to do. Like we do it for free. I mean, someone can just call us and we'll put a lot of time into it and tell them what we think. Like, because that can help inform so many other things. And the majority of people we meet with, they usually have a number in mind. That number is not grounded in anything though. Like oh, I golf with my buddy at the country club and he sold his business for 14 times EBITDA, so mine's probably worth 14 times EBITDA. And it's like, well,
and it was all cash and no taxes and no debt.
always. And like, you and I know like people like to brag and like usually the reality of the situation is actually different.
14 partners, line of credit, all of that.
But like we're usually delivering worse news than they're expecting to hear on that valuation discussion. Like usually they have a number higher than is reality. And I view that as just really unfortunate because, if you think I'm going to sell next year and I'm going to get $10 million and you're only going to get 4, well, that probably changes your retirement drastically, right? And it's like,
oh my gosh, I've seen it, Adam. Like,
yeah.
I mean, and actually, one of my clients passed away in the middle of all that shit. So they thought their company was worth $7 million. The wealth manager put so the company was doing $14 million in revenue, 1.6 million in EBITDA, 1.5 or something like that. $7 million valuation is what they had on their personal financial statement. No taxes, no debt. So it was enterprise value, not net proceeds. After the valuation, debt, taxes, it was 2.5. Guy was in his 70s, kept going, and then passed away. I mean, just like what the, it just like, it literally made me, it crushes me. But I think you highlighted where I've landed, Adam, is that if there's anything people can do is focus on understanding the value of the asset. Like people don't go buy real estate and hope it's worth something, or they don't go sell their house without looking at the market.
Yeah. You don't have a 401k and don't check the balance for 20 years. Right.
I know.
What I mean? Like
it's yeah, I know. Isn't it weird? And like goes back to my annual planning thing. It's like, you're going to spend 12 months next year doing hard shit. Right? Like whatever you're doing is
really hard. It's
really hard. Yeah. And like, where are you spending your time and where are you putting your money? And like hoping that it just like is worth something. The whole thing is just crazy to me.
I totally agree. Again, I'm not trying to give you too big of a commercial on your own podcast, but like what you do is hugely valuable. And I think this education piece and awareness thing is, I'm seeing a little bit more of it in the market, hopefully over the next,
it's huge.
However long we both are doing this, hopefully quite a while, like hopefully it gets even better. Right. And hopefully we can be part of it because it's a big deal.
I want your thoughts on what I think. I feel like I know what they're going to be, but I want maybe instead of you just agreeing with this is maybe get some nuance of like what could make this situation better. So like, I think, let's say I kind of gave you the insights of like annual planning. I think they should have an ownership meeting the day before their 2-day EOS. If they're doing the 2-day EOS, I'm kind of assuming people are doing EOS if they're listening in or something like it. I don't really care what it is, but so the ownership meeting is like build out your forecast, understand your distributions, how are you going to fund the company next year? Like get a little bit of that shit together. And like somewhat guessing is better than completely guessing. Like, and I'm very open to, like they have to like use their own resources and constraints to determine what level of perfection they need. But at least understanding that to say how much money do we have next year? What are the things that will de-risk the cash flow and increase and de-risk the WACC to increase the multiple? Like that's the name of the game. With the finite amount of money that we have, pick those projects and then have that implement that into your VTO EOS with the rocks and all that other stuff. So like that, I think coming into the EOS planning meetings, that's what people should be doing. And I was on my group call with my clients that you're going to be coming into in a couple of weeks. And we were talking about like, all right, so how does everybody go to the US Pen? Everyone's like, we make shit up. It's just like, and it's just so fun hearing the like, yeah, for sure. And so we're talking about this, but let's say they like, and then if we roll that into the 3-statement model, I mean, like, again, that's next level. And I've learned this the hard way from, a lot of different of my old clients and my old partners and stuff like that but like, let's say this is done. Okay, so now we're looking at 2025. Here's where I want to bring you in, or people like you, and because I know your time is finite, I think there's a potential different way or things you can do to scale your company in a content fashion. But
I think you're probably right. We've talked about some of that. Yeah.
So here's where I'm going with this: is like I propose that people should have monthly ownership meetings, like a PE firm, where they review the number, they put the owner's hat on, they review the numbers from a PE firm standpoint, revenue, COGS, SG&A, balance sheet, cash flow statement, distributions, taxes, multiple, and EBITDA every month. And if they don't have it, they're just working towards that. Quarterly, I think people should have a board of advisor meetings where they're sitting down with the tax mitigation specialist like Roger, or they're sitting down with the CPA firm, their estate planner. And it's just like, even if it's super loose or they just do it individually, I'm absolutely believe having someone like you come in once or twice a year to say, because like in the 3-statement model, someone could cash flow, that we can run a cash flow projection to say like your company could only cash flow 40 grand a month in debt. Like, so like that, like if you're doing an internal buyout, that's all you got. But like, I think that everybody always needs to have an understanding to have complete clarity of like, should you do an internal buyout or work towards an ESOP or keep the company, or is now the right time? And then have someone like you say, what the hell's going on in my industry, Adam? What's going on with private equity firms? Like, so explain, like, if that dynamic was going on, what would you do? And what kind of value, like how would that conversation go? And why would you do that potentially for free? Is that, you follow me here?
Yeah. I know you wanted me to maybe disagree. I agree with everything you just said, for one. For two, here's why we do a lot of upfront work for free. It's relationship building, right? So we want to prove that we know what we're doing and we can add value to business owners. We also want to get to know them. Like, are they someone that we think we can add value for and can work with and all that? And ultimately, oftentimes that results in a formal engagement where we're working on their behalf and we get a success fee. Sometimes it doesn't. That's okay. But that's kind of why that's the economics, at least, of why we do it up front.
To get to your 10 to 15 perfect deals. Because you're managing the time, cash flow, equity, growth trade-off, just like all my clients, right? So you're doing that for your own.
Yeah. Frankly, to get 8 deals done a year, we probably have to talk to 40 businesses, right? So it's a lot of conversations. I think that's exactly the right cadence. Like we are thrilled if someone wants to kind of do a quarterly or biannually call or meeting with us where we can kind of give them a renewed sense of valuation for their business. We can give them an M&A market update. We can tell them what we're seeing, what we're hearing. We back that up with data. Like I am not like a super touchy-feely like approach. It's like more data-based approach.
Your CPA is a background, right?
Yeah, I'm just giving you shit. And we're salespeople at Quazar, so we like the emotional aspect and all that matters. But like, I think a message is best supported with data. So if someone asks me like, what are you seeing out there in the market? I'm not just going to say like a lot of activity, a lot of buyers. It's great. Like, I don't think that's as valuable as like, it's busy. Here's the number of transactions in your market. It went up or down. Here's the average multiple. Like that's the language I like to speak. And we speak that as part of those update calls.
It's so important because like that data, Adam, and I was totally giving you shit, is like, I think it's like our brains work the same way. It's all of this is emotion because that's who we are as people, but it has to be backed up into reality. And we're trying to sync those two up, right? And like,
that's exactly right. Yeah.
And like your data is like, okay, truly what's going on right now? Is there, hot activity in my industry? Are there PE firms that are coming after this space? But like people don't know if they don't know. And if they can just, I mean, and then like what I think about this dynamic, Adam, is like, if my clients or the people that are listening are doing that kind of stuff, like the VOP, the financial model, and have that story told, it's very easy for you to quickly have a conversation instead of starting on first base, right? So it's like, then it's like, okay, now's the time. And like, it's worth it.
And it can unlock, I'll give you an example. So I spoke with a home services business. This was maybe a month ago. And home services businesses
are hot.
Some nuance to this, but
yeah.
They're hot and they've been hot and they're going to be hot for a number of reasons. There's an article in the Wall Street Journal all about it, I think like a week ago.
Peter Learman from Axial just wrote an article about that. You should check it out. By the way, are you on that site?
Yeah, we are.
So Peter's been on the podcast a couple times.
We got an award last year for one of the top 100 M&A firms in the world. Quazar received from Axial. So
no shit. Peter's been on the podcast a couple times. I really like him and what he's built.
That's awesome. Cool. Yeah, we framed it. It's our conference room and everything.
That's awesome. That's something that's worth. That's good for you guys.
We're proud of it. So, but I lost my train of thought.
The home services. Yep. Home services. It's hot.
Oh yeah. So I was talking to a home services company, and they weren't aware of these dynamics. And I think I added some value by saying like, hey, here's what's going on, but you got to be at a certain size threshold. Here's the data to support it. But if you can get there, what you thought was a 3.5 multiple business could be a 7 multiple business. And all you got to do is increase EBITDA by $300,000, right? And it's like, and it's like, oh my gosh, like that is a big carrot, right? And so like, and they
can you explain why the nuances of that matter? Why 300 grand? Was it going from like 700 to a million, or from 1.7 to 2?
It was 700 to a million.
Ridiculous.
Yeah, that's exactly right.
It's like the drop down. I always joke at my workshops. It's like the effing drop downs of Zillow. Would you like a 500,000, 750, or a million? And it's like everybody in PitchBook and all the PE firms came in and said 1 million, 1.5, 2 million, 3 million, 5 million, 10 million. And I'm just like, this is so funny. At the end of the day, it's cash flow, but there are those rules of thumb that are really important for you.
They are, particularly with private equity. I mean, private equity is generally looser with add-on investments, right? They tend to not have hard lines in the sand. Some do, some don't. But with platforms, they have very hard lines in the sand. Like if I'm a private equity group and I don't buy stuff less than 3 million of EBITDA, I'm not buying something if it's 2.5. Of a platform. They're pretty rigid about that.
Yeah.
So
yeah.
It sounds ridiculous because it's like, well, it's just a round number. Like who cares? It's a round number, who cares? But like that, it does matter.
At 1.999.
Yeah, it's like you're out, Ryan. Earn an extra dollar. Earn an extra dollar. Come back to me.
There's one more ad back in there, Adam, I promise. So back to your this has been so fun. I don't know if there was something that we forgot to close the loop on there about the I know what I was going to ask about the ongoing valuations, Adam. So there's this intrinsic cash flow valuation I think people should always be monitoring, using the financials, closing out every month, and then a couple data points a year, someone with you getting the market valuation. And then I think that also helps people then build the comp plans for their C-suite. Like when we were with Mike Fromelt, who was on the panel with you, it's like we're using hopefully the cash flow valuation for the comp plan and stuff like that, but we're having an idea like we just it's just information, right? Like I don't know.
No, well said. I mean, more information makes better decisions, makes more valuation, right? Like that's just kind of how it flows. I think that's been the theme of our conversation, right? I want to tell a quick story about you, Ryan. We have a minute. If people have made it this long, if you're at the end of the podcast, it's a good story. But so I don't know if we had met before, but the first time we really met was we presented together for Jake Parsley.
Yeah.
Shout out to Jake. Invited us to go. I think it was like a South.
It was a snowstorm. It was like an 18-inch snowstorm.
It was a South Minneapolis business forum. And he invited us to go, and I'm like, great, who else is going? He's like, I know this guy, Ryan Tansom. He's going to do a great job. I'm like, fine. He goes, Ryan's going to go first. You're going to go second. I'm like, great. I put together a few crappy slides and was ready to go. I'm like, Jake, how many people are going to come? He's like, 40. So we get there. There's like 12 people there because we got like 1.5 feet of snow.
There was so much.
It took 2 hours to drive there.
I know.
I'm surprised we didn't even cancel it. So
that was before COVID and before all the virtual stuff.
Exactly. Yeah, this was pre-COVID. This was like 8 years ago. And so we get there, and you went first, Ryan, and I'm standing in the back watching you present, and you're just crushing it. And I'm just like, I'm like, you know, it's kind of like when you're a stand-up comedian or a band, right? You don't want the guy in front of you to like be better than you are, and you were way better than I was. And I'm watching you, and I'm like, gosh, mine's gonna suck. So you crushed it. I went up there. I think I put people to sleep. Like they like did not.
Oh, whatever.
They were not as engaged. But it actually really helped me. You're still a better presenter than I am. You probably always will be. But it did make me realize that like there's different levels to this stuff, and like I needed to up my game a bit in terms of slide presentation, delivery, things like that. And it was kind of an eye opener to me. So I
appreciate it.
I
I appreciate that.
All 12 people who braved the snowstorm, I think enjoyed your presentation.
Well, Natalie from Casa de Corazon is still a contact. I mean, like,
that's fantastic.
Yeah, it's 8 years ago. Yeah.
Well, I'm not surprised people talk to you and not me at the end. So like, I'm not.
She's not ready to sell yet. Oh my God, I can't even imagine what the hell my message was back then.
I don't even remember I don't even think I have my slides. Like,
but like it's and I think as we're sliding into home here, man, like all I've tried to do, Adam, is like to your point about that HVAC technician or the commercial cleaning or the engineer or the manufacturer or my dad who's a copier sales rep. Like none of us, like I got a D in accounting. I literally got a D. I was doing beer bongs. It was a Friday afternoon class at St. John's, and I would do beer bongs before because I wanted to go to the bar because everybody.
Well, those are important.
I know. Apparently, debits and credits didn't sink in, and I had to do those blue books. Oh my God. But I was like, I don't ever want to do this ever again in my life, and here I am. Like but I say this is like making it. Again, I tie it back into healthcare where like I didn't want to learn about the back in the human back in the way I've had to protect my wife from getting fused and cut and prescribed. And it's just like I'm so sick and tired of being a PhD and all this shit. And like there's this weird thing I think the advisor community, like we have to be perfect and professional, and then it doesn't resonate with someone that ate shit for 20 years building a business. And there's this like huge like gap of like, they're really good advisors. So like one of my goals is like, there are really good advisors out there like you who care. And when people like you who explain, this is how it's supposed to be done. I think there's such a lack of trust, Adam, that they're like, Adam is trying to screw me.
I think that's true.
And it's like, no, like, but like, how can they do, people have a hard time. I mean, I've, again, like it in the healthcare space, signal to noise, and then like the chances of getting screwed and it really impacting your life are so high that the risk of doing something is higher than the risk of not doing something. And I think that's what we're just trying to do. It's like, hey, like, let's make this stuff accessible. It doesn't have to be overly serious. And like, but like, it has to be better than it is right now.
I completely agree. And I on your point of there being a level of kind of distrust, I've seen that. I think my advice to business owners is take your time in making these decisions with who you hire, right? Like, I mean, sometimes when we're people are thinking of hiring us, we have to go in and what's called pitch, right? So we put together a presentation, we convince them we know what we're doing, we'll do a good job. And I'm frustrated. Sometimes like an advisor will line up 4 investment banks and we get 60 minutes and then the business owner decides. And it's like, that's fine if that's the process they want to run. We deal with it.
Yuck. But like, would you even want to deal with that person afterwards though?
Yeah, I think you need like more.
Maybe.
I just think as a business owner, like make sure you're comfortable with who you hire. Sometimes we're meeting with people 5 times, 10 times, right? Like, and that's okay, right? Like we are here to do a good job, but it's also our job to convince people of that, right?
Did you hear that? You ever heard the stat that 90, I think it's like something like 90% of people hire the first real estate agent they ever meet?
I have not heard that, but I'm not surprised by that.
And I think that my brain extrapolates things. So I think that's very applicable to advisors. Cause like, I mean, I hired our old CFO because I'm like, dude, he is so fun to drink beer with. And like, it was like, I didn't know what a CFO was supposed to be like. I don't want to do that job, but like, you're fun. And it was just like, no, shout out to you, Todd. Like, I love you.
And getting back to like what I like, business owners are busy, and like I get it. It takes time to like go to these meetings and meet people and do it again and ask questions, and like I know people like me start to blend together, right? If you're a business owner, you're meeting with 3 investment banks. They're like, it's probably not your best day of the week, right? It's like so like, and I get that, right? But like, make sure you feel good about who you hire, and that's not just true to an investment bank. It could be an advisor like you, Ryan. It can be an attorney. It can be a CPA. And go with your gut and do what you got to do to make sure you have that trust. And sometimes that can be a lot of conversations, and that's okay.
Yep. Dude, this has been so fun. I think you, I believe, have said yes to the 3 workshops next year. I can't remember if it's all 3 or maybe not the Florida one. We'll see.
TBD on the Florida one, but I'm probably going to say yes on that. So
okay.
I
by the way, the listeners need to know that you were a professional poker player before this. That's another sweet freaking stat that is just too good not to drop.
I was, and that gets back to my data approach. So quick 1 more minute on that. I think it's interesting. Maybe people are falling asleep like I do, but like I think people have a vision of poker of like guys smoking cigarettes in a room and like.
Come on, that sounds fun.
And like wearing cowboy hat and like
blue visors.
That was poker 50 years ago. It's all nerds now. So it's data based nerds. I consider myself one of them, so I can say it. Who are purely statistics based decision makers, and those are the only people who win at poker now.
What if you layer on emotional intelligence on top of that foundation? How does that?
It does help at the margins with poker, right? But
at the margins,
it is not that important, because what's happened is like if I go sit down and play a poker game, I'm not gonna like give off emotions. I'm gonna hide all that. So it's like you got to go off of like the best way to play the game, and I could spend a lot of time talking about poker theory, but that does inform kind of some of what I said on the podcast, and that's why I bring it up, where like data is really, really important. The more data you have at something, the better you are. And yeah, you're right. I like in poker, the emotional intelligence helps at the margins. In business, I think it's really, really helpful, right? So it depends on what we're talking about.
Well, if you just, I think poker, I mean, this is why I call it independence by design. The second step is choose your game. Because like business is a game, but like your game that you're playing of how you want to manage your time, cash, and equity is different than mine. And like how we're managing our own constraints. So here's how I like to think about this. And I think poker fits in and business fits in and life fits in, is like clarity on the goal is the first thing that has to be beat through and have so much clarity. Because that's why it's step 1. It's like, where are we going? I mean, if you and I sat down with 2 computers and AI, and I knew exactly where I wanted to go and you didn't, I would be able to get there faster, because AI just helps people get where they want to go faster. That's it.
100%.
And then it's like, then the second part is then understanding how to align your constraints with that goal.
100%.
Right. Yeah. And then it's execute like a mother effer. And then hopefully you get there and then continue to pivot. And so like, I think about like, to your point about data, if we don't have it, we're just guessing.
You're just guessing and getting back to poker, but like there are solvers now that the really, really good poker players study and they probably spend 1/3 of their time studying and 2/3 of their time playing. I mean, you have to study. And I do this now. I've gotten behind the times. I'm not one of the best players anymore. And like, but like that is true in poker. It's true in business, and it's true in life. And emotions matter. And if you can have the EQ with the IQ, like that's great, right? But I do try to lean on some of my poker lessons in what we do here, and I think it's helpful. I really do.
It's been so fun, dude. Where can people find you?
If you go to quazarinc.com, that's QUAZARINC.com. That's our website. My bio, contact information is all on there. If you listen to this and you just want to chat, give me a call, send me an email. Happy to talk to anyone about anything, even if it's just poker.
And then, like I said, for the listeners, I'll be putting the registrations out and some of the information about the workshops next year, probably soon. And we'll be having 3 workshops next year that hopefully I'll be publishing. And I've already got people like Adam sitting on the panel in the afternoon, which is pretty sweet, man. It's been a lot of fun.
Oh yeah, I've really enjoyed. I like the seminars you put on. The vibe is good. Like the content's fantastic. You do obviously a great job, but just like the energy in the room is something that I guess I didn't necessarily expect, and it's been great. It's been really.
Dude,
good.
what did you think? That because like, dude, I think I repel people that don't like energy. like they don't like me too much.
I just like this, like, I think you're the driving force of that, but I mean, it's like, it's this genuineness with this informalness mixed with the great content. Like, you don't see that all come together very often, right?
I appreciate that, man.
Like,
And
I
like,
go
you know
to
what?
like seminars where it's 4 dudes in suits and ties and it's boring, and like, that is not what
70 years old talking about estate planning, and you gotta have a trust. And
yeah, it's super boring. So I'm grateful to be part of it. Thanks for getting me involved, and thanks for.
Well, it's so fun, Adam. I mean, like it's like I remember you walked in here. I'm like, hey, these are all business owners. I'm like, yeah, these are all people doing real shit. They're making things, doing things, making money, and they're eating glass every day. And I'm like, yeah, these are the value creators. All right, dude, I know you got to run. Thank you so much for coming on.
Oh, thanks for having me, Ryan. This was really fun.
If you're still tuning in, I hope you enjoyed the time I had with Adam. Here's a couple takeaways I wanted to leave you with. One is that I know I talk about what good looks like, and I just want to make sure that people don't think that I think it's easy, because I know all of this shit is super hard. What I'm trying to do and where my passion comes from is to help people realize the full potential so that you don't go through something that I've gone through. And like, it breaks my heart when people could be doing things that could increase their chances of having more time, more cash flow, more wealth, more freedom, if they were focused on getting the alignment of what their activities are doing every day, of how you're spending your time and your investments and your strategies aligned towards creating more value and cash flow. And otherwise, we're just guessing. So like when I talk about, the 3-statement model or the VOP, value growth stuff, or like, talking to someone like Adam every, couple times a year, all this stuff is hard while we're managing growth, managing payroll, managing banking, managing all the stuff we got going on. But like, I just think the hard work is disproportionately worth it if we're willing to incrementally work on the hard work. And that's where I'm trying to just make sure that my content can help you understand what you're working on, and whether what you're working on will be the one thing. I don't know if anybody's read that book, The One Thing, but the one thing that moves everything forward and makes everything else easier. So I just wanted to make sure that everybody understood that I don't think it's all that easy at all, but like the unrealized potential breaks my heart, because the people that are listening in are doing the stuff that is creating value in the economy. You're not just doing derivatives and financial engineering and sucking cash flow out of the system like a lot of other players in the marketplace. You're out there, participating, as Teddy Roosevelt says, you're in the arena, and those are the type of people I want to help. So hope you enjoyed the conversation with Adam. Let me know shoot me any emails if you are looking for topics that you want me to cover, but I'm having a lot of fun and hope you're enjoying this. Share it with a friend or give it a rating if you enjoy it. See ya.